So many business owners I speak to are very intrigued about capital raising, and on the surface level, I think it's very, very challenging. And I just wanted to jump on here and talk about why actually it can be very, very easy when you place your efforts in the right place, but also have the right asset you're trying to raise capital against. And I think this can be explained by what I'm calling the inverse funnel of capital. And it explains why raising capital becomes significantly easier the larger your business is. So on the left-hand side, you've got businesses, and if we take the UK market, for example, at the bottom here, we have a load of small businesses across the UK. So below £1 million worth of EBITDA or profit, there are tons of family-run, family-owned businesses that are treated more like lifestyle companies as opposed to professionally run businesses. And if we look over on the capital side of things, there's a direct inverse correlation between the amount of capital available for smaller businesses than there is for large professionalized companies that could go to any high street bank or alternative asset provider and raise capital really quite easily. So if I talk on the specific type of buckets, at the bottom here, we have, say the average ticket size of less than £1 million is less than £5 million. That's a really challenging space to raise capital on in the UK. If we move up to 1 million to £5 million worth of EBITDA, you're normally raising between 5 to £25 million worth of capital. That actually becomes really much easier to raise on. If you think about these type of companies, they've scaled to at least £1 million worth of profit a year. And therefore, in order to do that, they've managed to, one, establish some really good market share. They've clearly got a very good and well-defined product or service offering, and they've scaled the business beyond just themselves. So they must have a team in place that are doing things for them, and the business isn't relying solely on them driving new business or very reliant on them to grow. Although in most instances, they are still very, very key within that company. Now, if we move up even further from 5 million to 15 million pounds worth of profit, it becomes even easier to raise capital or achieve an exit. And the usual ticket size within those camps, those size of businesses, are about 25 to 75 million pounds. If a business is scaled to £5 million worth of profit, the storm it can weather is normally a lot greater than if a business is making maybe £100,000 worth of profit that could be wiped out by one customer saying no and turning off their supply. And so that's the reason why, as we go up further and further in size, it becomes easier and easier to raise capital. Now, that's all good and saying, but obviously you need to scale your business to get to that size in order to attract the capital. There's actually a trend with this capital that's actually showing that capital is starting to filter down from this 5 million to 15 million range down to the 1 to 5 million EBITDA range. And the reason for that is that private equity houses and institutional lenders are under tremendous amount of pressure to spend capital. But that has to be caveated with spending it with high quality businesses. And so a lot of private equity houses and also financial institutions have been chasing the same deals. They've been going after £5 million to £15 million profit-based businesses, and they're all competing for the same deals. And therefore, that means it's very, very challenging and competitive to spend your money. And so what's been happening is a lot of private equity houses are moving down to what we call the lower mid-market or small cap deals. The reason for this is that the volume of attractive companies increases, and therefore their chance of being able to spend and allocate their capital into an attractive and well-run business is significantly higher. Also, the volume amount of deals coming to market is higher, and therefore, if your sole job is to spend money, then you've got a larger pool of businesses that you can spend into. And so the conclusion here is that as you go through that life cycle in your business to carry on growing and scaling larger, the easier it is to attract capital. And right now we have a sweet spot in this lower mid-market to raise capital and achieve some exceptional exits for business owners if they're sitting in that 1 to 5 million EBITDA range.